On April 13th, 2026, Goldman Sachs reported earnings and gapped down almost 4% at the open. Most traders panicked. One mechanical rule said, do nothing until the close. The day closed strong, in the top quarter of its range, so the rule bought the next morning near 894. The stop went at 865, the target at 952. 4 weeks later, the target hit. Plus 2R, modeled. Here is that rule, the level mapped for the July 14th report, and the trade where the same rule loses. Why would one rule work on an earnings day? Because the report morning is the one moment the whole market reprices Goldman at the same time. Look at January 15th, 2026. The report dropped before the open, and that single session swung almost 6% from high to low. Then look at April 13th. The next report, and this time price gap down 3.5% at the open. Across the 8 reports, from July 2024 through April 2026, the average report day swing was close to 4%, several times a normal session. Here is the honest part. You cannot predict which way it breaks. Nobody can. But you do not need to. The reaction day itself tells you which side won, and it tells you at one precise moment the closing price. So stop guessing the report and read the verdict the market prints at the close. The next report lands on July 14th, before the open, so mark the map in advance. Up top, 1,125, the June 18th high, the ceiling of the whole move. Closer in, 1,039, the July 2nd high, the first ceiling price would meet from below, and underneath, the round number 1,000. Sellers pushed Goldman into that shelf twice in June, and both times buyers held the line. None of these levels predict the report. They are the shells and ceilings the reaction will have to trade through, so draw them before the number drops, while your head is still calm. Here is the whole rule, as one picture. On Goldman's report from April 13th, 2026, you do nothing all day. You let the whole session play out. Then markets range from the low near 865 to the high near 897. Then read the close. A quarter of the way down from the high sits 889. Close above that line, you plan a long. In the bottom quarter, a short. In the middle, no trade. Here, Goldman closed at 891, 81% up its range deep in the top quarter. A clear long verdict, so you buy the next open. One example can be luck, so run the same tree on January 15th, 2025. Goldman reports before the open, and the day finishes strong. The close lands in the top quarter, so the verdict is acceptance. You buy the next open at 610. The stop sits at 593, the bottom of the report day, about $17 of risk. The target sits near 644. 5 sessions later, the target fills for the full 2R. Same steps, different report, same arithmetic. Now the one that hurts, because if you trade this rule, you will take this trade too. January 15th, 2026. Goldman beat estimates. The session swung huge, and it closed strong in the top quarter. By the rule, that is a valid long signal. You buy the next open at 973. The stop goes at 925, about $48 of risk on the biggest report day range of the whole set. The target sits near 1,070, and then the verdict gets rejected. Sellers press the market lower, day after day, and 5 sessions in, the stop fills, minus 1R. Done. That is the gap and trap. A strong close that reverses, and no rule filters every one of them out. Which is why sizing is the rule behind the rule. On a $10,000 account, risking 1% means $100. Divide that 100 by about $48 of risk per share, and you get 2 shares, small enough that the trap costs you 1%, not your account. Now the honest part. Here's the full record. Every Goldman earnings report from July 2024 through April 2026 with no cherry picking. Watch the same rule run through all 8, one at a time. Each report, the close lands somewhere on its own meter. Top quarter, the rule goes long. Bottom quarter, it goes short. A middle close, it stands aside. 3 of these reports won, 2 are apiece. 3 were no trades, where you risked nothing and kept your powder dry. and 2 were losses, including that brutal gap and trap. 3 wins, 2 losses, 3 no trades. Stack every winner, every loser, and every no trade together, and across the entire set, this rule finished at plus 4R. Not a jackpot, just a small, repeatable edge. The plan on 1 card. 1. Mark the levels in advance. 2. On report day, do nothing until the close. 3. A top quarter close arms the long plan. A bottom quarter close arms the short plan. 4. A middle close means no trade. 5. Enter at the next open. Stop at the far end of the report day. Target 2R. 6. The audit. Across 8 reports, 3 wins, 2 losses, 3 no trades. Plus 4R modeled. If mechanical, honest breakdowns like this help you, subscribe for the full library. None of this is financial advice. Trade the plan, not the prediction.